So we're going to start with the Satrix Divi Plus fund, which tracks an index put together by the FTSE JSE people, which has an enhanced dividend distribution. You'd be very interested to know what kind of stocks make it in there, but they pay out the dividends quarterly. It's got a current market value in issue, which is not really the indication of the market cap or anything, but there is units in issue of around 1.5 billion rand. So that just is an interesting aside. Yes. So explain to us how they decide which stocks to put into this thing and the relative appeal compared to other opportunities on the market.
So the Dividend Plus Index looks at companies that over the next year are expected to pay an above average dividend. So it's based on a forecast dividend yield.
Interesting.
And it excludes the property stocks because they pay a high yield anyway. So you can buy that through a property tracker. So this is out of the top 100 stocks on the JSE, excluding property, those 30 companies with the highest expected forward dividend yield.
But how would you know what the expected dividend yield is going to be? Because some of these companies that are in the index, like let's use the one which I think is a big constituent because I saw it on the fund sheet, like Nampak, which is actually having a very bad year currently share price wise, but has been generous with dividends in the past.
So let's explain who
decides?
And where is the sort of the danger with this type of methodology. So who decides is the FTSE JSE Index Advisory Committee. There's a set of rules, and how do they sort of decide? It's based on analyst forecasts. So this one contains a component of forecasting in there, which can be right or it can be wrong, just like any other forecast. So the example that you raise of Nampak, I think, is a very good one. If you are looking at a company that is not followed as actively by analysts, you often find that those forecasts can become stale. So, and we saw that in the last probably about 2 to 3 years, specifically with our mining companies.
So something like Kumba, for example.
Yes, exactly. Used to pay very good dividends, and then analysts were not quick enough to actually update their forecast of the dividends that would be paid out. Also, bear in mind, it's a dividend yield. So there's two things at play there. There's the dividend, and then there's the price. So you could also, like in the case of a Kumba or many of the other mining companies, as the dividend forecast remains the same level, as your price falls away, that dividend yield just goes higher and higher.
For a while.
But they are low price for a very good reason.
But people who own this thing own it because they want the yield that it produces, and they're not so worried about the price?
They shouldn't be, because that's really the purpose of this type of ETF, is to provide higher dividends, and it's fulfilled that role. The Dividend Plus, the Satrix Divi Plus, has gone through a very interesting life cycle. It's one of the older dividends. It was the first so-called smart ETF that we had in South Africa. It started off with exceptional performance, and there were a lot of retail investors that piled into this.
Because it was in an era when the market was rising, companies were doing well, and they were paying good dividends. And then people said, well, this is like miracle because it's giving us upside, capital growth, and it's ferreting out interesting companies
too. And then on the basis of sort of the past strong resource cycle, we ended up with it a few years ago having a lot of mining companies in it. In fact, it had over a third of its constituents were mining companies about 2-3 years ago. Now, we all know what happened to commodities and to mining companies, so the performance of it over the last 2-3 years have been dismal, and a lot of people have lost faith in it.
And so people think this thing is a bad thing. Can't own it, it's out of fashion and so on and so forth. But why did you bring it up today? Are you hot or not on it? Are you thinking that there's a new opportunity?
Yes, I do think there is, because where it had a lot of mining companies in it, most of those have now been taken out. So we had a good recovery during the first quarter, still had all those mining companies in there.
That looks to be the chart that we're seeing
there. So there you can see that recovery that it's had early in 2016 with the mining companies. Then in March, they reviewed the index. They removed a lot of those mining companies.
How often do they meet to review the index?
This particular index is reviewed twice a year.
Sounds to me like they should have a meeting once a month.
Then there would be nothing left for the active managers to do. So at the moment, it has a lot more financial shares in it. We do know that the likes of our banks, for example, are paying exceptionally good dividends and are expected to sustain those dividends. So I feel a lot more comfortable with the Satrix Divi. Am I hot or not on this one? At this stage, can I be mild? But I would be leaning to the side of hot on the Satrix Divi.
Towards the side of hot. You know, apart from Nampak, there are also companies like MTN in there and big holdings, Barclays Africa, another one. So what's interesting for me is that sometimes there seems to be a lag here. So you could get lucky, but it could also be a source of risk.
That's why I'm mild on it. But if you're looking for dividends, it's great. If that's not part of what you're looking for in your investments, then maybe that's not your answer.
Okay. Well, you're going to go hot. I'm going to go not hot, just on a count out.